In this video, we will explain the concept of a simple moving average, a commonly used technical analysis tool. A simple moving average, or SMA, is a mathematical calculation that helps to identify trends in stock prices. To calculate the SMA, you add up the closing prices of a specific number of periods and then divide by that number. For example, if you are analyzing a 10-day SMA, you would add up the closing prices of the last 10 days and divide by 10. The result is the average price over the specified time period. The SMA is useful because it smooths out short-term price fluctuations, making it easier to identify long-term trends. Traders and investors often use different SMA lengths, such as 50-day, 100-day, or 200-day, to analyze different timeframes. When the price is above the SMA, it indicates a bullish trend, suggesting to buy or hold the asset. When the price is below the SMA, it indicates a bearish trend, suggesting to sell or avoid the asset. Some traders also use the crossover of two SMA lines, such as a short-term and a long-term SMA, to identify buying or selling signals. The SMA can be applied to any financial asset, including stocks, commodities, or cryptocurrencies. It is important to note that the SMA is a lagging indicator, meaning it reacts to past price data, not future price movements. While the SMA is a useful tool, it should not be the sole basis for making investment decisions. Traders and investors should use the SMA in conjunction with other technical indicators and fundamental analysis. The SMA has its limitations and may not work well in highly volatile or erratic markets. In conclusion, the simple moving average is a popular tool in technical analysis that helps identify trends and smooth out price fluctuations.